Hello, this is Dr. Nunez. Welcome to the Chapter 22 problem solving session. So we're looking at components of the master budget, and we're going to start this session with the production budget in basic exercise 22-2. So our production budget is a function of the sales budget and beginning and ending inventory. We want to produce enough to cover our sales plus or minus the change in inventory. So in this exercise, we know that the projected sales are 700,000 candles for the month of March. And they're estimating their beginning inventory at 40,000. So this is the beginning inventory, right? This is what they anticipate having on hand at the beginning of the period. And what they want to have on hand at the end of the period is the 25,000 units of product. So we've got the three components that we need: the sales, what they anticipate selling, what they'd like to have on hand at the end of the period, and what they expect to have on hand at the beginning of the period. And all we need to be able to do is put all of these components together and put them together, and then we'll be able to determine the number of units that should be produced. So let me see if I can copy and paste here. So there's our production budget. So again, the production budget is a function of what we expect to sell, 700,000 candles, plus what we need to have on hand at the end of the period, 25,000 candles. So the total amount of candles that should be available is 725,000. But we're going to start with 40,000 candles in the beginning inventory. So we only need to produce 685,000 candles. We are actually producing less than we plan to sell. Why? Well, because we're going to take 15,000 candles out of the beginning inventory. We're going to start with 40,000, but we're going to end with only 25,000. We're taking 15,000 candles out of that inventory. So we only need to produce enough to cover our sales minus that decrease in the inventory. And that's a production budget. Again, a function of those three things: what we expect to sell plus the ending inventory minus the beginning inventory. Now let's take a look at purchases, a purchases budget. So a purchases budget is kind of the same logic. We want to make sure we purchase enough to cover what we plan to produce, plus what we need in the ending inventory, minus what we need in the beginning, well, minus what we have in the beginning inventory. So let's see what we're given here. So in this case, we have a budgeted production of 685,000 candles for the month of March. 685,000 candles for the month of March. And we know that wax is required to produce a candle. In fact, what we're being told here is that they need 8 ounces of wax to produce each candle. And they're estimating that the beginning inventory, March 1, that beginning inventory is going to be 15,000 pounds of wax. But the ending inventory is going to be 14,500 pounds of wax. And the cost is $1.20 for a pound of wax. So we need to approach this kind of like what we did in the illustration problem for the lecture. We need to know how much wax we're going to need for production. We need to know how much wax we're going to need for the inventory. And then we're going to need to know how much we'll be buying and what it's going to cost. There's a lot of pieces that we need to be able to put together. And let me see again if I can kind of copy and paste, and then we'll kind of walk through the components that we need. So let's see here. Okay, so let's kind of walk through this. So this is the first thing we're given. We are given the budgeted production in candles. They anticipate making 685,000 candles. That's this number, right? They plan on making 685,000 candles. And they need 8 ounces of wax to make a candle. So this is the ounces that they need to make a candle, right? 8 ounces to make a candle. So 685,000 candles times 8 ounces. These are the ounces that they need for production. They need 5,480,000 ounces for production, ounces of wax. But the thing is, in this exercise, the inventory is not in ounces, it's in pounds. And candle wax costs $1.20 per pound. They buy it in pounds. So because everything else is in pounds, we're going to convert the ounces that they need for production to pounds so that we have a common denominator. And since there are 16 ounces in a pound, we're just going to divide by 16. So we're going to take the 5,480,000 ounces that we need for production, divide by 16 ounces, and these are the ounces that they need for production. They need 342,000, I'm sorry, these are the pounds that they need for production. 342,500 pounds are needed for production. So we've just converted again to a common denominator, pounds, because that's what we have in inventory and that's what we're going to buy. We're going to buy wax in pounds. So we multiply the 8 ounces times the number of candles we plan to produce to get the total ounces. And then we take those ounces and we divide by 16. And now we know we need 342,500 pounds of wax for production. And there's some kind of an ending inventory that we're going to need, 14,500 pounds. So we're going to need 14,500 pounds. So those are our needs, right? The pounds that we need to have available are 357,000 pounds of wax. But we're going to start with something. We're going to start with 15,000 pounds in the beginning inventory. So we don't need to buy 357,000 pounds because we're going to have 15 in the beginning inventory. That means we only need to buy 342,000 pounds of wax. And the wax is going to cost $1.20. That's 410,400. That's our budget. So again, we're going to purchase enough to cover what we need for production. 342,500 pounds are needed for production, plus what we need for the ending inventory, minus what we have in the beginning inventory. We need 342,000 pounds of wax, and it's going to cost $1.20. So the key complication in this exercise is recognizing that we start out with ounces, right? The number of ounces that we need for our candle production and converting that to the number of pounds that we are going to need to purchase. Because again, the candle wax is purchased in pounds, the candle wax in inventory is in pounds. We need everything in a common denominator. So that's our purchase budget. So we're purchasing enough to cover, again, what we need for production. In this case, we're only going to purchase 342,000. We're purchasing something less than what we actually need for production because we're taking some from inventory. Inventory is going from 15,000 to 14,500. So we purchase enough to cover production, in this case, minus what we are taking out of inventory. And that's our production, that's our materials purchases budget. Now let's take a look at cash. And we're going to start out by looking at the cash payments. Cash payments. So the basic information that we have here with respect to cash payments is when they make a purchase, when they purchase their supplies, when they purchase, candle wax, for example, they pay for 30% of their purchases in the month that they make a purchase. and then the other 70% in the month following their purchase. So what we know is that they're going to make purchases in August and September. But what we want to know is what's going to be purchased, what's going to be paid for in the month of September. So let me see if I can kind of summarize what we know so far. If I can copy that and paste it. So this is what we know so far. What we know is that when they make a purchase, they pay for 30% in the month of purchase. So they've got purchases of 50,000 in the month of August, right? 50,000 August purchases. They're going to pay for those 30% in the month of August, and the remaining 70% won't be paid until September. And the 60,000 that they purchased in September, well, they're not going to pay all of that in September. They're only going to pay 30% in September, and then they'll pay the 70% in October. So that's their pattern, right? 30% in the month of purchase, 70% in the following month. 30% in the month of purchase, 70% in the following month. That's how it's going to work out. And what we need to be able to do is determine the total amount that's going to be paid in the month of September, total amount that will be paid in the month of September. So as we look at September, let me see if I can go ahead and type here. In the month of September. So we've got some August purchases that will be paid. The August purchases were $50,000. And in September, they're only going to be paying for 70% of those August purchases. So in the month of September, we have payments of 70% times 50,000 is $35,000. That's what's going to be paid in the month of September. So I can move this over here just a little bit. Those are August purchases paid for in the month of September. And then we also have some September purchases. And the September purchases were $60,000. But we're only going to be paying for 30% of those September purchases in the month of September. So in September, 60,000 times 30% is 18,000. So in the month of September, we're paying for 70% of the August, 35,000, and we're paying for 30% of September, 18,000. Or altogether, we're paying for 53,000. 53,000 is going to be the total amount that is being paid for purchases in September. Right? That's our total for the month of September, 53,000. So as we look at this month, we want to focus in only on these numbers, right? We're only going to be paying in September for 70% of August and 30% of September. We don't care about the 30% in August because we're not doing a budget for August. We don't care about 70% in October because, again, we're not doing a budget for October. We're just doing a budget for September. So we only need to account for these two numbers, 70% of the 50 and 30% of the 60. And those are budgeted cash payments for purchases on account for September. Okay, so let's take a look now at another production budget. We need a production budget for these two products, for the bath scale and the gym scale product. And the production budget is for the month ended in January. And again, a production budget is a function of sales and inventory, right? So we want to be able to produce enough to cover our sales plus or minus the change in inventory, plus the ending inventory, minus the beginning inventory. That'll give us the number that we need to represent our production. So let's see, I should be able, again, given that we have here, we've got our sales. We know that we're going to sell 135,000 of the bath scale product and 80,000 of the gym scale product. And then we also have our inventory information. So we know what the beginning inventory is, right? So these numbers represent beginning inventory of both products, right? So that's kind of the beginning inventory. And then we've also got some information about the ending inventory. That's what these numbers represent. They represent the January 31 or the ending inventory of those two products. So we put these pieces together, right? Put the sales together with the ending inventory. So sales are here, ending inventory is here, beginning inventory is here. All we have to do is, again, make sure that we produce enough to cover sales plus the end minus the beginning. So our production budget for these two products. There we are. So let's start with the bath scale product. So with the bath scale product, what we anticipate here is that we're going to sell 135,000. So there are the sales, 135,000. We're going to have a desired ending inventory of 15,000. We only need to have 15,000 on hand at the end of the period. So 135,000 plus the ending means we need to have 150,000 bath scales available. But we're going to start with 11,800. So subtract that 11,800 and what we're left with is what we need to produce. 138,200. So we're actually producing more than we plan to sell. Why are we producing the extra units? Because the inventory is going up. Inventory is going from 11,800 to 15,000. So we've produced enough to cover our sales plus the increase in inventory. And we do the same thing for the gym scale product. So we plan on selling 80,000. Going to sell 80,000 of those. We need to have 7,500 on hand. So there's a 7,500. That means we need to have 87,500 units available, but we're going to start with 8,100 units in the inventory. So if we're going to start with 8,100, we only need to produce 79,400. So we're actually producing fewer units than we plan to sell. Why? Because we're taking some out of inventory, right? We're going from 8,100 to 7,500. So again, basic production budget. We want to make sure that we produce enough to cover our sales plus or minus the change in inventory. Plus or minus the change in inventory. Now, we're going to look at the integration of two budgets, the sales budget and the production budget, in exercise 22-6, the sales budget and production budget. So the sales budget is pretty straightforward, right? The sales budget is a function of price times volume, right? All we want to be able to do is multiply that price times volume, and that will give us our sales budget. And then the production budget, well, the production budget is just going to be a function of sales plus or minus the change in inventory. So sales plus or minus the change in inventory. So again, the sales budget is going to be pretty straightforward in that we're going to multiply the price times what we plan to sell. And here are all the sales volumes, and here are the prices. So let me see if I can squeeze in everything we need here. Hopefully I can. So let me see if I can shrink this down a little bit because I'm going to need some room. to get everything in here. Okay, so there's our sales budget. And again, all it is price times volume. So we anticipate selling of this Rumble product 11,000 and 14,000, or a total of 25,000. And these units are being sold for $70 each. That's the sales budget, right? It's the volume times the price gives us total sales revenue. And then the Thunder product, we anticipate selling 3,500 and 5,500 is the volume times the price. And then we just, excuse me, then we just add everything together, right? So then the total sales of the Rumble product plus the total sales of the Thunder product gives us the total sales budget, price times volume. That's all that is. And that sales budget is going to feed the production budget because the production budget is again just a function of what we plan to sell, right? We plan to sell 25,000 and 9,000. And we have the desired ending inventory and we have the expected beginning inventory. Put those pieces together and we've got a production budget. So hopefully I have again enough room to get everything in here. So our production budget. There's our production budget. Okay. So again, we anticipate being able to sell 25,000 and 9,000. So you can see here from our sales budget, 25,000 and 9,000. There's the 25,000 and the 9,000. So the expected units to be sold, sales budget. And then we want to add in the ending inventory. So we anticipate that we're going to have an ending inventory of 500 for Rumble. There's our 500. So plus 500 means we need to have 25,500 available. And we anticipate that the beginning inventory is going to be 800. So we want to subtract out that beginning inventory. That's what we need to produce. Produce enough to cover what we plan to sell minus the decrease in inventory. Inventory is going from 800 to 500. We're taking 300 out of inventory. That's why we only need to produce 24,700. And then of the Thunder product, we plan to sell 9,000, right? 9,000 here, 9,000 expected sales, plus the ending inventory. We anticipate a need for 400 units at the end of the period, but we're going to start with 300. So we need to have 9,400 available, but we're going to start with 300. We only need to produce 9,100 units of that Thunder product. Okay. So this exercise just gives us a chance to look at uh at two pieces, two integrated pieces, the sales budget and the net sales budget feeds the production budget. Okay, so let's take a look now at exercise 2211, which is the materials purchases budget. So now we get a chance to take a look at another look at materials purchases. Looked at that a little while ago, but now we have an extended example, kind of like one that we did in the illustration problem that we did in the lecture. So in this case, we have two products. And I'm going to do my best to get everything on here, and then we'll just kind of talk through it. So we have two products. I'll talk a little bit about it first. We've got two products. We've got the passenger car and we've got the truck product. And both of these products need tires. And they need rubber for the tires and they need steel belts for the tires. So we've got to make sure that given the need for tires, we have enough rubber and enough steel. So we need 42,000 tires for the passenger car product, and we need 19,000 tires for the truck car product. So those are the production needs, right? We're going to be producing 42,000 passenger car tires, right? And we're going to be producing 19,000 truck car tires. And again, we need to make sure we have enough rubber and steel belts to make these tires and enough rubber and steel belts to make these tires. And these are the needs for each tire. And we've got some prices too. And we've got some information about ending inventories. So these are the ending inventories. And then we've got some information about the beginning inventories. So we have all the pieces, right? We have the production. We have the amount of materials needed to produce. We have the beginning inventory, the ending inventory, and we have the prices. And now we need to put it all together and work through this step by step to develop a materials purchases budget. So let me see if I can get all of this on here. Okay, so let's get started. We'll work through one product at a time. Let's look at the car tires and the amount of rubber that we're going to need for these passenger car tires. So we plan to make 42,000 tires. So there's the budgeted production, if you will, of these 42,000 tires that we're going to be selling. 42,000 tires. And each one of these tires needs 35 pounds of rubber. So 42,000 tires times 35 pounds of rubber means that's the amount of rubber we need for passenger tires. But then for this truck product, we need, we're planning to sell 19,000 of these tires, and that's what we're going to produce. And so each one of these tires needs 78 pounds of rubber. So the tires need the 78 pounds. That's 1,482,000 pounds of rubber. So this is the rubber that we need for the passenger car tires. And this is the rubber that we need for the truck tires. Put it all together, and this is the total amount of rubber that we're going to need for the production and sale of these tires, passenger car tires and truck tires. But that's not necessarily what we're going to buy, because we're going to have 40,000 pounds of rubber on hand at the end of the period. That's what we plan on having on hand at the end of the period. So that's really what we need, right? We need to have available 2,992,000 pounds of rubber. But again, that's not what we're going to buy, because we're going to have 46,000 pounds in the inventory at the beginning of the period. So subtract that out, and all we need to buy is 2,946,000 pounds. And it's going to cost $1.20. That's our materials budget for rubber. So one more time, we start by determining how much rubber we're going to need for our planned production and sales of these tires. So 42,000 of the car tires, each tire needs 35 pounds. That's 1,470,000. 19,000 is what we plan of the truck tires. Each tire needs 78 pounds. So these are the total pounds needed for the production, plus the ending inventory, minus the beginning inventory. Those are the total pounds that need to be purchased at $1.20. Same thing for steel belts. We, again, for passenger car tires, plan to produce and sell 42,000 of these. Each one of these tires needs 5 pounds of the steel belts. So passenger car tires need 5 pounds. So this is the total amount that we need in terms of steel belts. Truck tires, though, need more than that. They need 8 pounds. So the truck tires are going to need 152,000 pounds of steel belts. Put it all together, total steel belts that we need. But the ending inventory needs to be 10,000. So we're going to need more for that. So the total amount that we need, total pounds of steel belts that we need to have available, 372,000 pounds to cover what we need to produce and sell these tires, plus the ending inventory, minus the beginning inventory, gives us what we need to purchase. And it's going to cost 80 cents per steel belt. That's our purchases budget for steel belts. Put it all together, rubber plus steel belts, and that's our purchasing budget for this company that's making these tires, making and selling tires. So that's a good example of two products and two direct materials. Now let's switch gears and look again at cash. But we're going to focus on cash receivables, cash that's being received for sales that are made on account. So the receivables. And that's going to take us to exercise 2217. Exercise 2217. So let's talk first about the collection pattern. Let's make sure we understand what's happening here. So first of all, this business wasn't organized until January 1, which means we have nothing prior to January 1. So everything starts here. This is when it all starts, on January 1, with sales for the first 3 months. So we've got our sales for January, February, and March. And the collection pattern, so the collection pattern is actually a 3-month collection pattern. 75% in the month of sale, 15% in the month following sale, and then the remainder, or the last 10%, will be in the second month following sale. And what we need to know is how much is going to be collected in all 3 of these months, January, February, and March. So let's see if I can just kind of schedule out that collection pattern. It really is helpful in these problems if you try to visualize what that collection pattern looks like, so you can easily schedule the collections based on the pattern that you're provided with. So I like to always prepare a nice little schedule or table that shows the collection pattern so I know what I'm working with. So in this case, the collection pattern, here's what it looks like. We've got sales for 3 months. Those are given. January, February, March sales. There we go. January, February, March sales. And the collections happen 75% in the month of sale, 15% in the month following sale. So make a sale in January, $400,000 worth of sales in January, you collect 75% in January. And then you collect another 15% of that 400,000 in February. And then you collect the last 10% of that 400,000 in March. Same thing in February, right? You make a sale in February. In fact, you have $600,000 worth of sales in February, but you only collect 75% in February from February sales. And then you collect 15% from February sales in March. We don't care about the other 10% in April because this budget is only for January, February, and March. And then in March, you would collect 75% of those March sales. So let's go ahead and schedule out those sales. So let me see if I can try to do a little typing here. So in the month of January, right? So in the month of January, what we're going to be collecting on is 400,000 times the 75%, which is exactly 300,000. Right? Exactly, 300,000. That's what we're going to be collecting on in the month of January. And that's it. It's just the 300,000, right? Because they weren't organized until January 1. So there's no business prior to January 1. So there were no sales prior to January 1. So on January 1, they start selling product. And for the month of January, they only sell 400,000. They're only going to collect 75% of that 400,000 in the month of January. But now what happens in February is now they're going to collect on some of those January sales, right? So now we have the 400,000 that they sold in January. They're going to be able to collect on 15% of those January sales in the month of February, or 60,000. So they're going to collect on 60,000 uh, in February from January. And then also in January, they're going to be collecting on some of those February sales. They had $600,000 worth of sales in the month of February, and they're going to be collecting on 75% of those sales. Or they'll be collecting on $450,000 worth of those sales. And that's a total, right? If we put together a total here, a total in the month of February would be $510,000. That's the total that they're collecting in the month of February from both the January sales and the February sales. And then in the month of March, so now in March, what's going to happen is they're still collecting on January sales, right? So now we still have the 400,000 from those January sales, but they're only collecting on, there's only 10% left, right? They're only collecting on the 10%. So we're only going to be seeing $40,000 from those January sales in the month of March. And then also in March, we have those February sales. We're still collecting on some of those February sales. In fact, we're collecting on 15% of those February sales, right? So now we are able to collect on $90,000 of those February sales. And then the last piece of this, we have some March sales, right? We have $850,000 worth of March sales. We're going to be collecting on 75% of those March sales, which is going to be $637,000, $37,500 is what we're going to be collecting on in March from March. If we put it all together, in the month of March, what we're going to be collecting on is a total of 767.5. That's what it looks like. Those are the collections that we're going to see in the respective months, right? So 300,000 is what we're going to collect on in January. 510,000 is what we're going to be collecting on in the month of February. And 767,500 is what we're going to be collecting on in the month of March. And those are our collections. Okay, we have just one left here. Let's go ahead and finish off this last one. And again, that's another cash collection one. And that's one that's pretty comprehensive. We've got a lot going on here. Let me see if I can kind of break this down a little bit beforehand. So what we have here is a business that has cash sales and they have credit sales. That's kind of the complication here. They've got cash sales and they've got credit sales. And what we need to do is show all collections, right? A schedule of cash collections, which is everything, right? Whatever's being collected, whether it's a cash sale or a credit sale, we want all of it. We want all of it in October, November, and December. So what's happening here is when they make a sale, right? They estimate that 25% of their sales are cash, and the remainder, or the other 75%, is credit. So that's the thing, right? So what that means is when they have sales in October of 58,000, well, some of that is going to be cash. In fact, 25% of it will be cash, and the other 75% of it will be credit. That's basically what they're telling us, right? Make a sale and you got 25% in cash. And you got the rest of it. Well, the rest of it's just going to be credit. And we know that when a company has credit sales, well, they don't necessarily collect them all at the time of sale, right? It's going to be spread over a period of time. And in fact, it's spread over 30%, 70%, 70%, 30% when you make the sale, and 70% in the remaining month. And every month is going to look like that. So what we need to be able to do is essentially figure out what those sales are going to be, given that it's again 25%, 75%, and then we've got some sales that are coming in, 30% in the month of sale and 70% in the next month. So let me see if I can kind of schedule that out here. So let's see, I'm going to just type a little bit here. So 25% of the 58,000 is 14,500. Those are the cash sales. On the other hand, 75% is 43,500. Those are credit sales. And then we're going to do the same thing for the November sales and the December sales, right? We have 25% and 75%. So let me see if I can just move this up a little bit, and we'll do the same thing here. So we're going to have, let's see, in the month of November, cash sales are going to be, if we multiply, I think it might be easier actually if I multiply times 25%. That is going to equal cash sales of 16,250. And when we multiply times 75%, that is going to equal 48,750 in credit sales. And same thing here. When we multiply times the 25%, we're going to get the cash sales that are going to be $18,000. And when we multiply times the 75%, we're going to end up with the credit sales of 54,000. So that's what we're told, right? They make a sale in the month of October, 25% is cash, 75% is credit, and that's what it looks like. 14,500, 43,500. Same thing in November and December. And we've got some information here about accounts receivable on September 30th. Oh, what does that mean? Why are we given that? Well, any sales that they made in September, 75%, remember, were credit sales. And they only collected 30% in September. The other 70%, they're not going to collect until October. So we're going to need to show those collections in the month of October. So again, the basic pattern is going to be 30% in the month of sale, 70% in the following month. So we need to show collections in each month. So let me see. I have, I have some headings that we could use here to kind of make this just a little bit easier, I think. Okay, so I've scheduled out all the cash sales, right? Collections. In October, we're going to be collecting 14,500 in cash sales. There it is. In November, we're going to be collecting 16,250 in cash sales. There it is. In December, we're going to be collecting 18,000 in cash sales. There it is. So we started out by just multiplying the 25% in cash sales times the actual sales, and I've listed it here. And then we've got the accounts receivable balance on September 30th of 35,000. Well, that's going to be collected in the month of October. So I've filled in all of the cash sales. All we have to worry about now are those credit sales. The credit sales for October, November, and December. And that's a piece that I can kind of paste in here as well. So let me see if I can put that here. At least part of it. Okay. So now let's only focus on the credit sales. So the credit sales in October are 43,500. There they are. And we're going to collect 30% in October. And we're going to collect 70% in November. And then we've got credit sales in November. That's the 48,750. There it is. We're going to collect 30% in November and 70% in December. And then we've got December credit sales of 54,000. There they are. We're going to collect 30% in December, and the 70%, that won't be until January. We're not doing a schedule for January. We're just doing October, November, and December. So let's go ahead and show the total amount that we're going to be collecting in the month of October. So those October credit sales, let's see. And I'm going to put here what we're going to be collecting in total from the month of October. I could kind of shrink it down a little bit. That would help. There we are. Okay. So in the month of October, we are going to be collecting on 30% of the 43,500. 30% of 43,500 is 13,050. So in the month of October, we got some cash sales. Yeah, we got 14,500 in cash sales. And we're still going to be collecting on some of those sales from September. So we've got that accounts receivable balance there. And then we also have 30% from those October sales. So three pieces, right? We're collecting on this, and this, all of that. That's what we're collecting in the month of October. Or we put it all together at the bottom here, and I'm going to wait to do that after I fill in everything for November and December. I'll put totals in. So we pretty much have to do the same thing in November, right? In November, we are collecting on the cash sales. Right, we've got some cash sales from November. How much? 16,250. It's right there. And in November, we're still collecting on 70% from October. So 70% of the 43.5 is the 30,450. So again, credit sales, 30% in the month of sale, 70% in the following month. And let's look at November now. November's going to be the same pattern, right? 30% in November, 70% in December. There we are. So in November, we're going to be collecting on 30% of November. 30% times 48,750. There we go. 30% of 48,750. That's everything we're collecting in November. Cash sale, 16,250. 70% of October, and 30% of November. So this schedule, this is really key, understanding what the sales are and when they're going to be collected. 70% in October, 30% November, 30% November, 70% October. And then the last piece here is just the December. Okay, so I filled in what's going to happen in December. In December, it's just the 30% of December. 30% of the 54,000 is the 16,200. And I also filled in the totals. So in the month of October, we're collecting on the cash sales for the month of October. We're collecting on the 70% that remains from September, the 35,000 that's in accounts receivable. And we're collecting on those October sales, 30%. Altogether, that's 62,550. And in November, we're collecting on cash sales. And we're collecting on 70% from those October sales and 30% from November sales. That's our total in the month of November. And then in December, we're collecting on cash sales again and 70% from the last month, 30% from the current month. Altogether, that's $68,325. Well, that's it. That's it for what I've assigned from chapter 22. I hope this has been helpful and hopefully it will give you what you need to be able to complete the application assignment and the quiz for chapter 22. And I'll see you next in chapter 23. That's it.